Hello, everyone. My name is Radia, and I lead marketing here at CSI, an affiliate of Moody's. We're happy to welcome everyone to today's webinar, a second in our series of Financial Literacy Month events, with today's webinar focusing on the power of behavioral insights. Before we begin, the ratings, financial analysis, projections, and other observations constituting part of the information contained herein are and must be construed solely as statements of opinion and not statements of fact or recommendations to purchase, sell, or hold securities. We strongly recommend you speak with a qualified financial advisor regarding your own unique circumstances. We ask that no one record this webinar without Moody's explicit written permission. Lastly, no one has permission to quote any of the comments made or questions asked by the webinar audience. Today's webinar is being recorded. All members of the audience are currently on mute. If you have a question, we encourage you to please type it into the Q&A box on your right-hand side. And we ask that you please keep your questions as generic as possible and avoid personal or client-specific information. Now on to the webinar. Today's webinar will explore how advisors can increase their understanding of the emotional and cognitive factors that shape decision-making by taking a deeper look at behavioral insights. We will also discuss the connection between behavioral insights and client relations, regulatory practices, and investor protection. Joining us for this conversation are three industry experts: Tanjim Hussain, professor and chair for the Department of Management at the University of Toronto and Rotman School of Management. Tanjim is also the director of BEAR, Behavioral Economics in Action at Rotman, and holds a PhD in economics from Princeton University. He is a leading expert in behavioral economics, specializing in field and lab experiments within applied microeconomic theory and quantitative marketing. His research bridges academia and practical application, advancing strategies grounded in economic behavior and decision-making. We are also joined by Shannon O'Malley, Director of Member Experience Design at Meridian Credit Union. Shannon is an expert in quantitative and qualitative research, tackling customer experience challenges across technology, financial services, and insurance. She is widely recognized for her work as a published author in top academic journals and holds a PhD in cognitive psychology from the University of Waterloo. Lastly, we are also pleased to welcome Mira Paleja. Mira leads the Behavioral Insights practice at the Ontario Securities Commission, bringing extensive experience in applying behavioral insights across government, the private sector, and academia. Mira holds a postdoctoral fellowship in cognitive neuroscience from McGill University and a PhD in psychology from Ryerson University. She champions the integration of behavioral science to craft environments that enable both individuals and organizations to flourish. Thank you all so much for joining us for this discussion. We are excited to get started. So let's jump in with a primer on behavioral economics and why it matters for decision making. Tanjim, could you please elaborate on that for us?
Thank you, Radia. And welcome, everyone. So what is behavioral economics? Economists traditionally assume that people are fully rational, or homo economicus. So what do homo economicus do? They maximize their monetary payoff or profits or some narrowly defined objective function, perhaps over a long horizon of time. Specifically, they do not make mistakes, utilize all the information they have, all the relevant information they have, but ignore the irrelevant information. They are not affected by emotions, and they don't care about other people and so on. That is obviously the simplification. In practice, people depart from full rationality quite often. However, this departure is mostly in predictable ways, or there are clear patterns in their departures from rationality. So people are not necessarily completely irrational, rather they are boundedly rational. So specifically, people do not optimize perfectly. They make mistakes, they have preference for honesty, altruism, other people, and so on. Sometimes they don't understand the state of the world very well. They have incorrect beliefs about that. So the goal for behavioral economics is to incorporate these patterns in boundedly rational behavior by people and utilize that to come up with more behaviorally informed economic models, and with the goal to provide more behaviorally informed policy decisions or policy prescriptions um, in both, like, uh, say, government and business kind of setting. So it's a large field, as you can imagine. Sometimes we think of behavioral economics as relatively new, but it's not really so new anymore. So today I'm going to talk about three specific areas of behavioral economics where I have done quite a bit of research, and I'll be drawing heavily from my own research, but also research by other scholars. Specifically, I will discuss prospect theory and loss aversion, salience and disclosure effects, and incorrect beliefs. So let's start. Maybe, yeah. So here is a question I ask my students in my classes. So, suppose you are asked to choose between two lotteries. Lottery A, you'll win $1,000 with 90% chance. Lottery B, you'll win $900 for sure. Most people choose lottery B over lottery A, which is not surprising. Both will give you $900 in expectation, so people prefer the sure shot. And sometimes I ask a slightly different question. I ask them, suppose you start with $1,000 and you have to choose between two lotteries. And if you choose lottery C, then you lose $1,000 with 10% chance. If you choose lottery D, then you'll lose $100 for sure. And most choose lottery C over lottery D. In fact, when I ask, or people have asked similar questions, even both scenarios to the same person, maybe slightly different time, many people would choose B over A, but then choose C over D. Now, as you're seeing these two scenarios side by side, you probably have realized that lottery A is exactly same as lottery C, because lottery C you start with $1,000 but lose $1,000 with 10% chance, and lottery B is exactly same as lottery D. Now, so if you are if you see those two, then choosing B over A but C over D is not consistent. Specifically, this kind of choices cannot be explained at all using the expected utility theory, which is a cornerstone of traditional economics. That brings us to our next slide, or a prospect theory. So Kahneman and Tversky, they are both psychologists, in 1979 proposed prospect theory, which slightly departs from traditional economics or expected utility theory, where they suggest that people, instead of maximizing their or looking at their expected utility of their absolute, like, profits or gains and profits or losses, people evaluate a prospect as losses and gains relative to a reference point. So the reference point is important. And they show diminishing sensitivity for both gains and losses, which is actually relatively consistent with traditional economics. But also losses loom larger than gains, which we call loss aversion. And so going back to our lottery, in the second set of lotteries C and D, we changed the reference point by starting with $1,000 and presented the same lottery in the loss domain. And that might kick in loss aversion in people's decision making. Now the question is, can we utilize that in designing incentive schemes. So I'll present result from a set of papers where we ran field experiments in China. So we went to factories and presented the factory workers with an incentive enhancement scheme. But there were two different framing of the same scheme. Some people were presented the gain scheme, where they were given a 4-week program where the worker will receive 80 renminbi in each week. They made a productivity target. And in the loss frame, they were promised 320 renminbi at the end of the 4-week program. But then they're told that this $320 renminbi will be reduced by 80 renminbi for each week their productivity falls below the target. So these are actually same incentive schemes, but some people received it as a bonus or as a reward, and some people received it as a punishment. But we find that they were getting paid like extra for higher productivity. So this bonus or incentive enhancement scheme increased their productivity in both framing. However, with the loss framing, the increase in productivity was 1% higher. So basically, with gain framing, the productivity increase was on average around 8%. In loss frame, it was about 9%. And there we are getting 1% increase in productivity, which seems not huge, but we are getting that completely for free. Now, if you think of like for a large organization, even if you get 1% increase in productivity for free over time, that can be actually quite large. And this result is quite a bit robust to variations. And we don't think that if this will work like forever, because the main thing we are doing is changing the reference frame. But if it's a long term, the change may not stay. But for short term productivity burst, loss seems to do better than gain. And we did a variation of this experiment where we again presented gain, the same incentive as gain versus loss, but instead of the goal being reaching a productivity target, we actually pitted two teams against each other. So two teams of workers doing the same work, they would receive the bonus if their productivity was higher than the other teams. But one team, this was presented as gain, the other team was presented in loss. There we found that, again, loss was more effective. Loss frame was more effective than gain frame, but not in terms of total productivity. It was actually 33% more effective in determining who won the contest. Specifically, under loss frame, the similar team would be more likely to win by 30%, 3% more. What it suggests is that while this departs from traditional economics, but traditional economics is still useful because the framing is manifested, but along the lines of the incentives. So when the incentives is on in terms of a relative terms, then the framing effect works in that dimension. So it also means that when you are rewarding some kind of workers, in which dimension you should put the framing depends on what your goal is. So if you are trying to motivate Toronto Raptors players, the goal, or the incentives, or even the framing should not be in terms of total points they win, because ultimately we care about them not getting a lot of points, but more points than the other team. So in that case, it should be in that direction. Okay. So let's move on to my next topic of disclosure and salience. So again, in traditional economics, we assume that people are infinitely attentive. They pay attention to all the information they receive. But in reality, they don't. None of us do. We focus on more salient information. In like financial forms, people don't look at all the detail, miss the fine prints a lot of times, but focus on more salient information. And so one area where this matters a lot is the price you pay. And a lot of times, firms charge partitioned prices or follow drip pricing, where some of the price is very salient, but some part of the price that you pay is hidden. So for example, there are hidden bank fees, phone and internet charges in hotels, shipping and handling fees or transaction fees in e-commerce. You can even think of taxes. In North America, posted prices do not include sales tax. In many European countries, they do. So there is a lot of evidence that people actually focus on the salient part of the price. So Raj Chetty and his co-authors, Raj is a famous economist at Harvard, showed that price tags that included sales tax led to an 8% decrease in demand. So they went to a grocery store and added for some products price tags that also told people the total price that would be paid, like including the sales tax. They also found that alcohol demand drops more with excise tax, which is included in the price, than with sales tax. With my co-author, John Morgan, I found that higher shipping fees in eBay auctions increased total revenue. In a recent paper by Steve Tadallis and co-authors, they showed that disclosing mandatory fees resulted on StubHub.com resulted in 28% decline in overall revenue. So it seems that people seem to ignore to some extent fees that are not very clearly marked when they make decisions. And government has taken notice. Joe Biden was very vocal against say unclear prices. And in the past 5 years, Competition Bureau in Canada has fined Cineplex, Ticketmaster, and StubHub for misleading pricing practices or deceptive pricing practices. So deceptive pricing does affect consumers. Now the question is it really optimal for firms to hide prices? So while if it's norm that there are some parts of the price is hidden, then if that is the norm, when prices are, so people do miss that. But is that necessarily optimal? So in a set of other experiments, we looked at that. Maybe you can move on to the next slide. So using internet auctions, we found that when the shipping fee is buried in item description, we find the same impact. Increasing the shipping fee by $1 boosts revenue by $13 or 13% more. However, if we made the price shipping and handling very clear and displayed it in the title, that eliminates this effect. So if the prices were not hidden, this partitioned pricing didn't have an impact. Well, what was interesting is that but when we compared these two regimes where shipping and handling is hidden versus where shipping and handling is actually transparent, they're actually the revenue we found in total was actually somewhat higher when shipping and handling were as transparent. So people were more like, they were more comfortable in bidding, and they were bidding slightly more in the auctions where shipping and handling was very clear. And so like, and evidence from, we had auctions in many different countries, and that showed that clearly disclosing shipping and handling increased overall revenue. And that actually makes sense. eBay did change soon after our paper, like not uh, entirely connected, but they actually changed their search uh, results, and they display shipping and handling on the search page. And that also resulted in revenue increase, some other paper found. So, and in general, in many places now, hidden fees are not as common. So, for example, I mentioned hotels, but nowadays, when you search for hotels, you can easily indicate that you want the total price, not all fees included. So, what it shows is consumer trust and their beliefs about the seller or perceptions of the seller play a key role in the revenue impact. And that brings me to my last topic, beliefs. So, how do people form beliefs? So, our world involves a lot of uncertainty. And we receive information from different sources, but they're not perfectly informative. The information we receive, like what will be the uh, say TSX index at the end of the year. We may have some prediction, or their experts may give us some numbers, but there is uncertainty related to that. So I have done some work on how people form their beliefs based on information they receive. So one area is correlated information. Think about, you're asking your friends about a restaurant they have been to. You ask 4 friends, you trust all of their preferences. You are quite similar, your preferences similar, you trust them equally. Now, these 4 people, when they tell you, each individually you value their information the same. But now, suppose out of these 4, 2 are husband and wife, other 2 are not related to each other, then 2 positive votes from the husband and wife may not be as strong as 2 positive votes or negative votes by the 2 other friends. Because the husband and wife, their experience is very similar. They probably went to the restaurant at the same time and so on. So their information is correlated. So how do we treat this correlated information? What many researchers found is people tend to ignore correlation. What we found is that people do ignore correlation or show correlation neglect, but they also they do that when information is very strongly correlated. But when information is very weakly correlated, they seem to actually do reverse correlation neglect, which we found surprising. That why do people's behavior change that way? What we realized is that while people neglect correlation, another in some sense, more important bias is that they don't understand uncertainty or variance. And they believe that their information is more certain than it actually is. It's a bias known as overprecision. And we show that when overprecision and correlation neglect interact, that actually leads to the results we find, that people seem to underestimate weakly correlated information. And we also looked at how people treat information when they receive a lot of signals, but sequentially. So in the next slide, I will show that when they aggregate sequential information, they seem to overemphasize recent data. This is known as recency bias. They also overreact to surprising information, and are often overconfident in their own knowledge. So as a result, they fail to completely leverage the wisdom of the crowd. Wisdom of the crowd is that when you have a lot of people getting information, their aggregated information is better than one individual's information. So we show that even when people make mistakes, there is wisdom in the crowd, but people don't take that wisdom into of the crowd into consideration as strongly as they should. They seem to underestimate how much aggregated information can reduce uncertainty. But we do find aggregated information aggregation does lead towards market efficiency, as traditional economics would suggest, but it does occur at a relatively slow pace. And this nicely illustrates that traditional economics can be enhanced by behavioral economics. It's not like traditional economics is not useful. It is actually very useful. It's as a starting point. So, behavioral economics should enhance traditional economics. In some sense, all economics should be behavioral, as our ultimate goal is to understand people's decision-making in the financial domain, and people are behavioral. Thank you.
Thanks so much, Dhanjam. That was really interesting to better understand people's behaviors. To complement, Shannon, could you walk us through the role that these insights play in actual client interactions and how they can benefit both clients and advisors?
Yeah, absolutely. Thank you. And thank you, Tanjim, for that excellent introduction to behavioral economics and some of the theory that underlies how we make decisions and how we look at investment decisions. I want to start by talking about why this matters, right? So we know from research conducted by BE Works and Manulife Wealth and Wealth Management that advisors who use behavioral coaching results in better outcomes for both clients and for financial advisors. So for clients, they are more likely to adhere to a plan. They tend to have more diverse portfolios and they have a superior Sharpe ratio. On the advisor side, there is greater trust in advisors from clients. Clients are more likely to consult a financial advisor in the future. And there's overall increased perceived benefits of working with a financial advisor. One of the challenges we hear a lot, though, is how do we actually take these insights, so things like prospect theory and loss aversion, and actually put them into practice with clients? There are three things I want to point to in terms of helping us do this and helping you start to take a slightly different approach. You might be doing some of these things already, admittedly. But I also want to, before I go into each one, I also want to call out that the examples I'm using here are really approaching this from a more holistic view, thinking about the client and their life and their decisions and their beliefs in a more holistic way and understanding how they come to you to meet with you and your client and what they need out of that exchange. I think there's a tendency within behavioral economics, somewhat popularized by Nudge and that sort of thing, to focus on what's the one little trick or what's the one little thing I can change in what I'm doing that's really going to make that big impact. And there really isn't one thing you can point to, right? It's an overall approach that I think requires a shift in how you're thinking about this. So the first part of this is really to lead with empathy and curiosity, right? You need to be a little bit like a detective looking to really understand what the client is looking for when you're meeting with them. What they're looking for might usually seem obvious, right? So on the surface, they might be coming for investment advice or to help them plan for retirement or manage their finances. But if we pull back for a second and think about how somebody ends up in the advisor's office in the first place, financial planning is a bit of a perfect storm for what we call the say-do gap, right? It's something that requires thinking about a long time in the future, planning for the future, making trade-offs between right now, what I'm buying and spending right now, and saving for tomorrow. And when you're young, there's not a clear deadline for when you should start building your portfolio and managing your assets. This leads many of us to procrastinate, right? We know we need to do it, but we put it off for another day. Even if we have assets that we're investing and we're managing on a regular basis, lots of people tend to want to set it and forget it and put it out of their mind. Because of that, the way people often end up reaching out to advisors is when there's a trigger event. If you've been working with clients for a long time, I'm sure you can quickly think of a few of these or a lot of these, right? It can be as simple as a change in their financial situation. So maybe they have a raise or a promotion at work. That means they have a bit more money, or it's tax season and they're looking to change how they're investing. Or they might be planning on buying a new house, which feels a lot more urgent than retirement. Some scenarios are much more emotional, right? So the birth of a child might have them looking to open an RESP. Perhaps somebody has come into a lot of money from an inheritance, which would suggest they've had a recent death in the family, or they have an elderly parent who's sick and they need to take care of them, and they need to figure out how they're going to manage work and taking care of their family. Taking the time to understand what their underlying motivation is really requires curiosity, right? Empathy requires listening. So the start of those conversations really looks like asking more questions than you're answering, and asking with open curiosity so it doesn't feel like an interrogation. Paying attention to nonverbal cues, what the person isn't saying, can also be informative. Ultimately, this will help you understand what they're looking for from the interaction. It will also help you understand what their underlying beliefs are, right? As Tanjin was talking about in terms of people have formed beliefs, understanding what those beliefs are can help you provide the right advice for that particular client. The next point that I'd like to point to is harnessing the perception of control. What do I mean by that, right? You can have an internal sense of control in which we feel like we have control over what happens to us in our life. I can take an action and that's going to have a positive output in my life. We can also have an external locus of control in which we feel like the world is just acting on us. We are subject to the whims of the market, and we don't really have much say in what those outcomes are. Of course, most of us have both, right? It's a balance between both. But some people have a stronger internal sense of control and some people have a stronger external sense of control. We know from research that when people believe when they have a stronger internal sense of control, they're actually more likely to save money. This makes a certain amount of sense, right? You feel like you have control, so you take actions to enact that control. This ties into what we might call self-fulfilling prophecy ultimately, right? What we see anecdotally is that helping people understand, particularly people who might feel like they don't have as much control over their finances as they would like, or they can't control the market and they're concerned about how the market influences their life, helping them understand the actions they can take to make changes and introducing them to the idea that they do in fact have some level of control over these factors, including what they're spending day to day, can make a huge difference in how they think about their finances. I tend to think about it like this. I saw a stat recently that most millennials believe they need, I think it's 1.7 or somewhere in that range to retire, right? If you are 40 and you have $100,000 in assets, getting to that 1.7 million can feel like an overwhelming hurdle. Starting to think about how you can take steps, have control over that, and now I realize the 1.7 is like a general number, right? But that's how people are thinking about it. They tend to think about it with rule of thumb mentality in terms of what they actually need to retire. And helping them see a path towards getting there, both in terms of the control, but also using some implementation planning and framing techniques, right? If we're talking about the say-do gap, we have to talk about implementation planning and framing techniques, which really at the end of the day are ways to break down the actions you need to take into simple steps, make it simple so that you're not presenting them with the entire plan all at once, right? Starting with what are the things you have to do today? What are the things you'll have to do in the future to get there? Putting timelines in place so that people understand when they have to take those actions by, and encouraging them to engage in commitment devices. So actually signing their name to say, yes, this is my plan. This is when I'm going to put it into play and how I'm going to do it. It seems like a simple thing, but it can have a big impact in terms of how people are behaving. And finally, reminders. I'm sure We all know this. Setting reminders makes a huge difference in people following through in terms of what they're actually doing. Sometimes they'll ignore it, but having them in place helps keep them accountable, helps keep them on track, helps bring them back when they get off track. I think it's worth also talking a little bit about the changing landscape of financial advice and investing, right? So AI is rapidly evolving, and our response and acceptance of it is evolving too. Why do we think AI advice is appealing, or why do people actually go to robo advice instead of advisors, right? In the early stages, I think we would point to people who are generally very confident in their ability to invest. They feel like they want to do it on their own. They're capable of doing so. And so they go to robo advice. And those are really those early adopters, those early stage people who are going to go after it and they're going to put everything into what they're doing. But I think we're quickly getting to a point where it's not just the early adopters, right, who are going to robo advice and looking to AI to help them do their financial planning. We're starting to see more and more people adopt it as acceptance of AI increases, but also because there are other reasons why people might avoid going to see an advisor, right? So a lot of times, particularly if you're early on in your journey or you don't think you have enough assets to meet with a wealth advisor, you don't want to go and sit in front of somebody and feel like you're being judged or feel like you're being told, this is not really here's all the changes you need to make, right? Here's the changes. It feels a little bit like going to the dentist office when they tell you you need to start flossing more. Yes, I know I need to start flossing more. I also know I'm probably not going to start flossing more anytime soon, right? So it's a bit of a push and pull to people actually wanting to show up and go and engage in this and engaging in those avoidance behaviors. And AI can be a step towards people engaging in a way that feels low effort, low cost, but starting to dip their toe in and starting to move forward. So you're starting to see people who are not necessarily as confident in investing explore that route. Now, for advisors, I think we need to acknowledge that more and more people are going to start using these tools. And so when we look at the value of behavioral advice, if we move on to the next slide, you can break it down into two things, right? What advisors are typically doing. There is financial guidance in terms of working with the portfolio, giving direct advice in terms of buying and selling and making those decisions. And then there's the emotional and behavioral guidance side of this, right? I think one of the fears has always been that AI advice is going to fully replace humans. And for some people, potentially that's going to be true, right? So some of those early adopters. But I think what's more realistic is we're going to land somewhere in the middle, that people will use both AI advisors and human advisors together, especially as we have, as I said, younger folks who maybe have lower assets who don't meet those advice thresholds first. They might start off engaging with AI and robo advice and then eventually graduate as their portfolios become more advanced and more complicated to a combined approach. But this means that historically, if you've spent more time focused on the financial guidance side of this equation, shifting so that you're also focusing and also having a strong position with the emotional and behavioral guidance side of things is going to really help bring you forward into this new world. It's going to help provide a value over and above what the AI advisors are able to give that then I think clients will really see value in and stick with as we go forward.
Great. Thanks so much, Shannon. It's always really helpful to understand during this time of so much change how there always needs to be that complementary approach to technology and human interaction and understanding each other. Mira, how do you see the application of behavioral insights impacting financial regulations? And do you think this will improve investor protection measures?
Thanks so much, Rabia, and thanks, Shannon and Tanjim, for those great presentations. And I think that leads kind of nicely into what I'd like to talk about, which is really around securities regulation and the integration of behavioral insights, specifically at the Ontario Securities Commission. So before I start, just the standard disclaimer that my views are my own and do not necessarily represent the views of the Ontario Securities Commission. So if you can go to the next slide. So to understand the value of behavioral insights and securities regulation, what we really need to understand are kind of what are the working assumptions of securities regulation. And something known as the efficient market hypothesis was really the dominating theory in the fields of financial economics. And what this theory essentially says is that the prices of financial assets always reflect all of the available information. And so one kind of theoretical assumption from that is that investors are mostly rational in how they will react to the information provided. So even though we now know that there are very real limitations to this theory, Canada's most important securities laws were actually written and adopted between the 1960s and the 1980s. And this was really kind of the golden age of the efficient market hypothesis. And so if we're taking the assumption of the efficient market, if regulators want to ensure that capital is allocated efficiently, what they have to do is ensure that there is correct and timely disclosure and dissemination of information that is related to the underlying assets, to these rational investors. So, in addition to the content that Tanjim presented, of course, even on an individual level, right? Do you read everything you're given to read? Do you understand it? Do you remember it fully and then act on it 100% of the time? So chances are you don't. So there's a belief that the public will read, understand, remember, and then act perfectly rationally on the basis of mandated disclosure. The problem with this idea is that this belief actually goes against decades of evidence from psychology and the behavioral sciences that shows that people are selective in attention, comprehension, memory, and behavior. So in other words, we are boundedly rational, as Tanjim already talked about, and this disclosure-based regime assumes that we're rational. So while these approaches like a disclosure regime and information-based practices, while they are useful and necessary for a regulator, they're ultimately incomplete in ensuring investors are behaving in a way to really optimize their experience. And so that's where behavioral insights comes in, not as a tool to replace traditional approaches used by regulators, but really as a complementary approach that can help fill gaps to account for human behavior when we're designing different regulations, policies, and educational interventions, such as the ones that have been carried out at the Ontario Securities Commission for quite a while. So on the next slide, so I'm going to talk a little bit about the work that we've done, and particularly in the last several months, where we've tried to apply some of this work or some of the theory to practical applications when it comes to enhancing the investor experience. So if you can go to the next slide. So these are some of our recent reports that were published. So 5 of them were actually published this year. And I'm going to talk to you today about the results from our 2 AI reports, our 2 gamification reports, and also our recent ESG project. So for the most part, all of these studies used a simulated trading platform with online participants. And participants were given a certain amount of fictional money to be able to carry out trades or change their asset allocation. And so the way these experiments were designed was that they used an approach called randomized controlled trials, which essentially means that different participants were exposed to different conditions, and we looked to see what kind of behavior they engaged in. And so the first set of experiments I'm going to talk about are 2 recent reports on gamification and retail investing. So one of them is a little bit less recent, so that was published in 2022, but our second follow-up to that was published just last month. And so both pieces of research examine the effects of different gamification techniques used by different mobile investment platforms on investor behavior. So this research really came about on the heels of the GameStop events in 2021. And we wanted to understand what features could be driving investors to make these decisions. So our 2022 research, presented on the left there, showed that rewarding participants with points for completed trades, so these were points with negligible economic value. So they didn't do anything for the bottom line of the participants. They were just points you received every time you completed a trade. So they resulted in an almost 40% increase in trading frequency. So that goes against kind of the conventional wisdom of buy and hold, overall kind of being a better strategy. And we certainly don't want something very arbitrary like points to be influencing investor behavior in such a profound way. A secondary finding from that work showed that promoting stocks on a top traded list led to a 14% increase in trading of those stocks. And so what presumably can be happening here is that when investors are engaging in this kind of herding behavior, it might be eroding their returns. So then our more recently published research, so this was published last month. So these are the main findings on the right-hand side. And what this research showed is that stocks that are promoted to participants through a social feed led to a 12% increase in trading of those stocks, while stocks promoted by a copy trader led to an 18% increase. So once again, a focus on trading specific assets could present a risk to investors, right? So this could be in the form of excessive risk taking or a lack of proper diversification. So ideally, we wouldn't necessarily want these factors to have such a huge influence in people's investing behavior. And so when you take these findings together, what our research shows is that gamification techniques can be used on digital investing platforms in ways that lead investors to engage in problematic behaviors. So that might include things like increased trading frequency and also herding behavior towards specific stocks. So on the next slide, I'm going to talk a bit about some work we published this past September. So our 2 reports on artificial intelligence and retail investing. So our first piece of research on the left asks, how is the average retail investor feeling about AI as a source of advice? And are they likely to adhere to investment suggestions from AI? So our behavioral science experiment tested investment advice coming from one of 3 sources. So people either saw the source of advice being from a human advisor, an AI advisor who we named Kai, or a blended human AI model. And what we found is that, interestingly, we saw a slight increase in adherence to advice in the blended condition. So the height of these bars represents a deviation. So that's in the opposite direction from the direction of the suggestion. So the lower bar means more adherence. And what we saw is that in the blended condition, there was slightly more adherence. This didn't reach our kind of stringent statistical threshold, but we thought that mean difference was interesting nonetheless. But what was actually even more striking was this research was done in kind of mid to late 2023. And so a lot of things have changed in AI in that time. There's obviously been rapid evolution of AI. But even at that time point, we saw that AI source of advice was treated almost equivalently to humans as a source of advice. And we thought that was a very interesting finding because we kind of expected human beings to really outperform AI as a source of advice that people trust. And then I'll kind of briefly talk about our second AI report. So that's represented by the bars on the right. And what we found here is that we were looking at the use of AI in scams, and we wanted to understand, could AI in scams effectively turbocharge what those scams look like? So what we were really looking at was the efficacy of those kinds of scams. And we also wanted to look at potential strategies to help mitigate them. And what we found is that if you look at the leftmost bar in the conventional scam, that's how much money people invested in kind of a conventional scam that has all the warning signs of fraud. So we saw about $4,300 out of $10,000 of fictional money that they were asked to invest went towards a conventional scam. But when we used AI to enhance this conventional scam, so this was really just entering a few keywords into a platform, asking to create a video that portrayed this kind of investment scam. And what we ended up deriving from that was a really quite sophisticated video showcasing this investment product. And then we saw the amount that people invested went up quite dramatically to $5,300. Then we wanted to see if we were able to counteract the impact using two techniques. So one was inoculation, which is letting people know in advance of seeing the scam that these are the warning signs of scams, that what they, here are the things that you might want to look out for. And we saw that using an intervention like that helped decrease the amount that people invested. We also looked at something called a web browser mitigation technique, but really what this looked like more so was on a hypothetical social feed, you saw an investment opportunity, and then directly below that, you saw a warning message. And we found that that actually had the biggest impact in helping mitigate the effectiveness of AI scams, to the extent that it actually led to less money invested than exposure to just the conventional scam. And so on the next slide, just one more experiment that we used to look at ESG. And so this was a different type of experiment. It was something called a discrete choice experiment. And what we wanted to understand was individual preferences for different kinds of fund attributes. So this you can see along the left, the different fund attributes. So just kind of pulling out some key findings from this work, we found that ESG ratings were a significant factor influencing people's decision-making. So it did influence consumer choice. And this was second only to funds' past performance. So that was something that was interesting to us, that the ratings had such a huge impact. But what was even more surprising to us and more interesting is that the way the ESG ratings looked had an impact on what people did. So when you have ESG ratings that are portrayed as star ratings versus letter rated, people were much more likely, they were much more likely to influence consumer choice. So people had a strong preference for star rated funds. So again, this is a completely arbitrary convention. It doesn't really matter whether they're star rated or letter rated, but nevertheless, it had a disproportionate impact on consumer choice. So that's what I'll kind of mention about our work so far, and kind of wrap up here. So that's it for me. Thanks, and back over to Radia.
Thanks so much, Mira. That was really fascinating. We do have just a little bit of time, a little bit over 5 minutes for the Q&A. So we'd love to try to get a couple of questions in for you all. I think, Mira, you might be able to answer this, and Shannon, maybe if you want to jump in. But in terms of behavioral indicators, what behavioral indicators do you believe regulators should monitor to protect retail investors better, especially with the rise of self-directed investing platforms?
Yeah, I think this is a good question. I mean, when we do our research, what we're really doing is looking at the impact of certain techniques and how they might influence the decisions that investors make. And of course, we're kind of paying attention to the ones that might be more problematic in terms of investor outcomes. So I think kind of taking the research in stride when these kinds of indicators are being developed, right? Are there uses of these kinds of gamification techniques that we know to be harmful might be something that could be beneficial in that regard. So certainly, there are ways to kind of turn what we do into evidence-based ways of developing indicators. And that I kind of see as like a complementary piece to kind of the wider breadth of indicators that we already use.
Makes sense. Shannon, did you want to add anything there?
Yeah, I think what I would add is when we're thinking about behavioral indicators, one of the challenges I think advisors face is they're dealing one-on-one, right? When we talk about behavioral economics and we talk about regulation, you're looking at it population-wide. You're looking at what are the overall trends. So as Mira is saying, they're looking at what are the tactics that you might be using that might be in play, like gamification, that might unduly influence investor behavior. When you're working with someone one-on-one, it's a lot harder to identify those things and figure out what is really influencing their behavior, because any one person might make a decision for a myriad of reasons, right? I think understanding your client well, knowing what their goals are, knowing their risk profile, knowing what their long-term plans are, helps you identify concerning behaviors faster and potentially guide them away from them as well.
Right, makes sense. And I guess I'll just throw more of a general question out there to all three of you, which is, do you think there are any emerging trends in behavioral economics that you believe will most impact financial advising and client behavior? I know we've talked about, the technology trends and AI, but any more niche specific trends that you think are emerging that might have an impact?
I'll go first. So one area that hasn't taken off, but is neuroeconomics. So, but I think there is actually quite a bit of potential in understanding people, like how so economists focus on choices, the actual choices we observe, but understanding how the brain is making its decision also is can be useful. And so I would think, and neuroeconomics started a while back, maybe like a decade and a half, but it hasn't taken off as much. But I think there is still a lot of potential there, on top of course, AI and machine learning and things like that are already there. People are using it a lot. And underutilized area could be neuroscience and neuroeconomics.
Great. That makes a lot of sense and probably definitely adds to the intrigue of behavioral economics. Was there anything else we'd like to add before we wrap up?
So maybe just to kind of add something as well. I think that there is one of the things like we're really interested, my team is really interested in it is, I've talked about in this presentation how some of these factors might be influencing behavior in a negative way. But we're also kind of looking at, how can gamification techniques, for example, be used for good, for example, to increase investor education, to help people make better decisions. And the same goes for AI. It goes for leveraging sources of information like social media. So, we have a tendency to think of social media as providing negative information that goes counter maybe to people's best interests. And that might be true in many cases. But I think there are also opportunities to help leverage these areas to really help improve decision making.
Great, thank you so much. Well, that brings us to the end of the webinar. This was such a scintillating discussion. It was really insightful. Thank you so much again, for all of you for joining. We are so happy that you were able to make it today. And if anyone has questions, please please feel free to reach out to us at support.csi.ca. If you registered for the event, you will get a replay of this event in about a week or so. It'll come to your email and you can watch it again or share with friends. For more information on upcoming webinars, please visit our website at csi.ca. And if you go to our insights section, you can see all the upcoming events for Financial Literacy Month, as well as some of our past events. Thank you so much for attending. Have a lovely day.